Hi, everyone, and welcome to our webinar today to review the impact of the new RevRec standards. Before we get it started and I hand it off to our presenters, there are just a few housekeeping items I want to go over. So just so you know, you can maximize or minimize the webinar pane during the presentation by using the red and orange arrow buttons. During the webinar, we definitely encourage you to ask questions. In that same webinar pane, you'll see that there's a questions box where you can then type in your questions and hit submit. Our presenters will answer those questions as time allows during our Q&A session at the end of the presentation. I also want to make sure everyone has good audio quality. So if you're using your phone today, make sure you select the phone call audio option. And if you're on your computer, please select the computer audio option. Now, if you're joining us here today for CPE, just a few things to remember. You need to be on your own personal computer, no smartphones, and log in with your own unique URL. You also need to be logged onto our online software for at least 50 consecutive minutes and make sure that you respond to at least 75% of the polling questions. Just a note for everyone, GoToWebinar did an update and we had some experiences with some attendees last time not being able to answer the polling questions. They did share with us if you exit full screen, you should be able to answer the polling, so that should eliminate any errors for you. Also, please be sure to make sure to complete the evaluation survey at the end of the webinar. Today's learning objectives are to identify how the new RevRec standards impact nonprofit organizations, discuss accounting treatments for PPP loan forgiveness, evaluate examples of how to apply the new RevRec standards, assess best practice recommendations to implement the new standards. And with that, I'm going to kick it off to our presenters.
Thank you, Marie, and hello, everyone. We really appreciate y'all joining this webinar. My name is Grant Lamb, and I am an audit partner here at Armanino. I'm based out of our San Francisco office, and I spend the majority of my year working with nonprofit organizations.
Hi, I'm Renee Ordino. I'm an audit partner based down in the Los Angeles office of Armanino. I too specialize in not-for-profit organizations, including social service organizations.
All right, so today's webinar is going to be focused on how the new revenue recognition standards impact the nonprofit industry, and specifically we'll look at ASU 2018-08 and ASC 606. We'll spend the majority of the discussion on ASU 2018-08. That's a grants and contributions accounting. ASC 606 did just get officially delayed one more year yesterday. We'll also take a look at the accounting treatment of PPP loans. A lot of nonprofits have been receiving PPP loans. We've been getting a lot of questions on this topic. And throughout the webinar, we'll also walk through illustrations and examples of how you would apply the new revenue recognition standards. There's a lot of content here, so let's jump right into it. One more slide. There you go. All right, so before we dive into the content, we thought it would be helpful to provide some context into nonprofit accounting and discuss why the new standards were issued. So first, a nonprofit that receives cash or other assets or services would recognize that receipt of that inflow as one of three ways. It's either going to be a contribution, that's a one-way exchange of value. One party receives money and the party that's giving the assets does not receive equal value back, or it's an exchange transaction, that's a two-way reciprocal exchange of value, or it's an agency transaction. That's where the receiving entity is really just acting as an agent or trustee of those funds. They don't really have variance power. They're receiving it and passing it right back through. It's a balance sheet only transaction. So it's important to first properly categorize a transaction so you know which accounting standard to follow. That's going to dictate the treatment of that transaction. Next slide. And the issue is that there's diversity in current practice, and challenges arise when you try to account for certain revenue transactions. And we're sure many of you can relate to and attest to some of these challenges. First, it could be hard to tell if you're dealing with a contribution or an exchange transaction. And if you have a contribution, It can get tricky trying to determine if you have a conditional or unconditional contribution. The accounting for government grants and contracts has also been a bit murky. Generally, government grants and contracts historically have been accounted for as an exchange transaction, but that's only been a matter of interpretation because there hasn't been definitive guidance on this matter. And there's also been a lack of clarity as to when and how you would apply 606 as a nonprofit. Next slide, please. So the goal of ASU 2018-08 is to provide more clarity around what is a contribution versus an exchange transaction and whether a contribution is conditional. And the goal of 606 is to align US GAAP with IFRS and also provide some consistency around revenue recognition. Obviously, 606 has had much greater impact on the for-profit world, but definitely some impact with our nonprofit community as well. So we'll touch upon that impact as well. Next slide, and I think I turn it over to Renee.
Yeah, thank you, Grant. So we're going to dive in a little bit deeper. First, going back to the question of what constitutes an exchange transaction versus a contribution. This is one thing that the standard 2018-08 really did a good job of clarifying. As Grant mentioned, a lot of organizations viewed these as exchange transaction. The idea was that the resource provider, such as a government agency, is providing funds for a service that the government agency would otherwise provide. Nevertheless, that while that viewpoint was a little bit logical, it wasn't entirely consistent with some other things in GAAP, and that has been clarified so that a benefit that's received by the public as a result of a grant made to a not-for-profit or potentially a for-profit is not going to be commensurate value. Now, there could be some cases, and in fact, I do have clients that have these situations where they enter into a contract with a governmental entity and the governmental entity is receiving commensurate value. For example, I have one client who has conducted research projects to provide to a governmental entity. So that's an example of where a governmental contract would continue to be treated under the exchange transaction rules and ultimately under the new standard 606. But frequently, if not, almost all the time, you would have a situation where a governmental contract is in fact a grant. That can be a little bit confusing. There's certain types of governmental contracts that are really written with a lot of performance requirements, and they might even be called a contract. It may be a contract for the purposes of a single audit consideration, but it still could potentially be a contribution under this new standard. So key point there, public benefit does not equal exchange transaction for a governmental entity. And on the foundation side or the side of an individual, the mission or positive sentiment from a donor is also not considered to be an exchange transaction. That's actually fairly long-standing interpretation of GAAP. The idea was that if you're making contributions to a religious organization, for example, your membership and the religious benefits that you get do not count as an exchange of commensurate value for the purposes of this sort of accounting and recognition. So we've really already gone through this, so I don't think we need to belabor it any further, but I will say that when it gets down to when you recognize funds under a governmental grant, there might not be a big difference between whether it's treated as an exchange transaction or a contribution, and we'll dive into that further later on in the presentation. So in some cases, it may not change when you are recognizing the revenue or how much revenue you're recognizing, but rather a presentation on your financial statements. And I think that we are now at our first polling question, and we're going to be honest, it's a little bit of a, well, I wouldn't call it a trick question, a little bit of a level setting question, because we're going to ask about whether or not something is a conditional contribution, and we haven't really dived into that yet. But you don't have to get it right to get CPE credit, you just have to respond. So quickly, we've got an organization, a center that receives a $1.5 million cost reimbursement grant from Health and Human Services to provide COVID-19 testing for the homeless population. The grant requires the organization to follow the rules and regulations of the OMB, and they can only be spent on allowable expenses. Any unspent funds must be returned to HHS. The center incurred allowable expenses of $1 million in year 1 and $500,000 in year 2. And our question for you all is the grant should be accounted for as a conditional contribution, true or false. So we're going to give you about 45 seconds or so to respond to that, and then we'll look at the responses and dive into the analysis. So we've got about 60% of folks voted right now. We'll give you another 15 seconds or so. Remember, you do have to answer at least 3 of the 4 polling questions in order to get CPE. So we want to make sure everybody has a chance to respond. Doesn't matter whether your answer is right or wrong. So it looks like we have about 73% of our participants responding. Marie, are we ready to go ahead and share the results?
Let's go ahead and close the polls.
All right. So about 68% of our respondents said true, this should be a conditional contribution. About 32% said no, it should not. So let's go into what we believe the accounting is and why we believe that.
Is this me?
So,
Or you want to take it, Renee, or do you want me to take it?
You can take it. Go ahead, Grant.
I just saw my picture there, so it
Yeah.
triggered me to speak. All right, so the answer is true. This grant from HHS is a contribution. The primary beneficiary is the general public. And as Renee mentioned, the general public is not synonymous with the resource provider. So the grant is a contribution, and furthermore, it's a conditional contribution. We haven't went over what a conditional contribution is yet, and Renee will do that in just one moment. And also Renee mentioned that under legacy standards compared to the new standard, there's not going to be a whole lot of difference in the timing, the amount, or revenue recognition. You're still going to recognize essentially the revenue when that condition is met. In this case, you incurring an allowable expense. So in this example, you incurred $1 million of allowable expenses in year 1, you recognize $1 million of revenue in year 1. You incurred $500,000 of allowable expenses in year 2, you recognize $500,000 of revenue in year 2. No difference between the legacy guidance and the new 2018-08 guidance. All
Great.
right.
So let's dive into what makes a contribution conditional under the new standard. And it sounds like our audience has a decent understanding of this perhaps already. So 68% of you did respond that it was conditional. So the new standard says that a contribution is conditional when both of the following things exist. There's a barrier that must be overcome, and there's a right of return of the assets transferred, which is usually money, or a right of release of the promisor's obligation to transfer additional assets. So 2 things that are really important here. One is that both of these things have to exist. If there's one or the other, then it won't be ultimately conditional. And I will tell you that in working with clients on this standard over the past year, this sounds somewhat straightforward, but interpreting agreements to decide whether or not there is a barrier, and I think particularly the right of return of assets has been a little bit more complex as we actually try and put the standard in practice. We also want to emphasize, it's right here in this big box, that a probability assessment is not part of this. Now, that was the way I think the majority of organizations were assessing whether or not a grant was conditional in the past. That was really because under old GAAP, there was one example of what could constitute a conditional grant, and that was a matching grant. There was also a sentence in old GAAP that says if it's a remote likelihood that you won't achieve the condition, then you can go ahead and record and recognize that revenue. They considered this as whether or not that should continue to be, that concept should continue to be part of GAAP, and concluded that no, it shouldn't. So even if it's something that you've been doing for a long time, and there's a 99% probability that you are going to end up doing it, then you still would not recognize it until you have overcome the barrier. So that's an important distinction, I think, for some organizations. I know I've had clients over the years who have, really considered that probability assessment in determining whether or not a grant is conditional or not. So the other thing that I wanted to point out about this is that generally speaking, we're expecting to see that the right of return is linked to the barrier. So it's not just that both exist, but that they are linked together. And I'll just read real quickly from the glossary about what a donor-imposed condition is. This is the FASB glossary. A donor-imposed condition is represents a barrier that must be overcome before the recipient is entitled to the assets. Failure to overcome the barrier gives the contributor a right of return of the assets it's transferred, or the promisor a right of return or release. So you can see that in that glossary definition, it implies that there should be a linkage between the barrier and the right of return or release. So let's go to the next slide and look at examples of what the barriers are. The standard gives 3 indicators of what barriers could be. And the first one is a measurable performance-related barrier. This one tends to be a little bit easier to locate or find. This is where you're going to have an agreement that says the organization must provide 1,000 meals at a soup kitchen or something like that. So if it's got a specific number and it's not simply an arrangement where we're here to fund your food program, but you're expecting, not just expecting actually, laying out a requirement to achieve a certain specific performance goal that can be measured, that's what this first one is. The second one is limited discretion by the recipient on the conduct of activity, and the third one, stipulations related to the purpose of agreement. And if you go in and look at the standard, there are actually examples of each of these, and we're going to give a few as we go through. We've got a slide actually that follows where we give examples of each of these and link them all in with the various right of return or release that might apply. So why don't we go ahead and move forward to that, because I find that the limited discretion and stipulations are easier to explain with an example. So we already talked about a measurable performance related barrier, and we'll come back to that. So let's talk about what is a stipulation related to the purpose of the agreement. It's defined as an additional activity or event exclusive of administrative tasks. So some examples would be a donor gives an animal shelter funds to expand the facility. It's specifically to expand the facility, and the expansion must accommodate a specified number of animals. That would be a stipulation related to the purpose of the agreement. if the grant is a research grant and the organization is required to prepare a report on its research and provide that either to the grant maker or the public at the end, that would also be a stipulation related to the purpose of the agreement. So let's see how that works in with the right of return or release. Can we go back to the matrix? Yeah. So in this particular situation, the grants, let's say both of these grants have multiple payments involved in them, and they have language in there that say the final payment of the grant will be made when the organization obtains its certificate of occupancy in the new facility for the animal shelter. So the implication there would be that the grant is conditional, or at least that final payment is, because the organization is not entitled to receive that final payment until it obtains the certificate of occupancy for the new facility. Same thing with the report on research findings. If it must be published in order to receive the final payment, then at least that final payment is going to be conditional. We'd need to look at the wording around the right of return or release to see whether or not any advances made earlier might also be conditional. An example of an unrelated right of return or release, in other words, something that's just trivial or administrative, is this in the column on the unrestricted ROR, where the recipient must provide a final report on the use of funds, or I'm sorry, we use a final audit report. So the agreement may say that you have to provide your audit report to the funder, and it's even possible that they would hold up payment. But this particular requirement is not related to the purpose of the agreement. It really is administrative in nature. And even if there's a delay in receiving payment because the audit isn't complete or something like that, or not provided, then this would still not be considered a right of return or release because it is administrative. The limited discretion, let's go through that for a moment. This is something that is more specific than a donor imposed restriction. And this one can get a little bit confusing. And in fact, the FASB ended up issuing some clarification from the FASB staff after the standard came out last year. So limited discretion is really about how the funds must be used. It's one thing to say you must use the funds for a specific purpose. That would generally result in a restriction. But if there's also very stringent stipulations on how the money is spent, that's when you've got limited discretion. So some examples here would be if it's a federal grant subject to uniform guidance. Those of you who receive federal grants, you know how lengthy, how complex the uniform guidance is, how much compliance is involved. There's really restrictions on it. Frequently, it's a cost reimbursement arrangement where you will not even receive the funds until you have expended costs under the grant budget and in accordance with the rules of the uniform guidance. So that is pretty clear. That means that most federal grants are going to end up being conditional. Again, there's probably going to be exceptions here and there, but generally speaking, if you've got a federal grant, it is likely to be conditional. State grants may also have these sorts of arrangements. We do a lot of organizations that receive funds from the California Department of Education, and that has a whole audit guide. It has a whole set of its own expenditure rules. So that's another example. An example that wouldn't end up being limited discretion would be kind of a general foundation grant budget. Now, we all know that when you're submitting a grant to a foundation, they are generally asking you to provide the budget. In most cases, although again, there are probably exceptions out there, in most cases, that grant budget is there to kind of lay out what everyone is thinking, to get some agreement on how the project might be conducted and to justify the request. Occasionally, foundation grants will say that you have to have approval from the foundation to change a budget. that what might not need to be looked at, but it still might not constitute limited discretion if it really doesn't get into the how it's spent. So when you all are evaluating your own grant arrangements, and you're thinking about this limited discretion, particularly where you've got a budget, I think the starting point would be, if you've got a federal grant, assume that it's conditional and look to see if maybe there's a reason why it isn't. And with a foundation grant, based on this barrier only, not necessarily the others, but on this barrier only, it's much less likely that limited discretion would cause a foundation grant to be conditional. Now, I do want to remind everyone that you don't have to have all three of these barriers. You have to have one barrier and one right of return or release. So Grant, I don't know if you want to add any comments to this before we head into our next polling question.
No, I think you did a great job explaining that. I've been manning some of the questions and have come in trying to answering there. So I think we're ready for the polling question.
Okay, great. Before we head to the polling question, I'm sorry, there was one more thing I wanted to go back to, measurable performance related barriers. So like I said, these are kind of easier to understand. You know, it's laying out numbers, typically, units of service, specified level of service, that sort of thing. So we've given an example here where a city basically is funding a homeless shelter, but the homeless shelter has to achieve 95% occupancy every month. If it doesn't, then the payment is going to be adjusted downward, pro rata, based upon the level of occupancy achieved. So that's clearly a barrier. The entitlement to the payment is based upon achieving that occupancy. A thing that you will frequently see in grant agreements is something like what's in this box up here in the top right. A second payment will be issued upon submission of a satisfactory progress report and financial report. This is where things get a little tricky. The report itself is most likely to be an administrative item. But if there are true barriers that are measurable performance related items, and you need to present the report in order for the foundation to determine whether or not you've made progress, then you could have an issue where it's not really about the report, it's really about the measurement and performance under that grant. So in that case, you'd really have to look to see, you know, how is there a real barrier? And so therefore, is that progress report really related to assessing progress against a barrier? The financial report would probably still be considered an administrative item. So yes, so now that I've gone back to that, let's head into that next polling question. Okay, so Joe Exotic Institute receives a $1 million grant from a foundation to perform research on wildlife preservation. The grant agreement includes a right of return as part of the foundation's standard wording. The grant agreement requires Joe Exotic Institute to provide a report indicating how the funds were spent. So let's see how this grant should be accounted for. And again, we'll give you about 45 seconds to respond. Oh, I don't know if you can see the whole thing. Well, it is, let me just read that for you real quick. The choices are unconditional because the likelihood of not submitting the report is remote. Unconditional because the report is administrative and not related to the purpose of the grant, or it's conditional.
And just as a reminder, if you're having trouble responding to the polling question, please make sure that you exit full screen, and then you should be able to respond.
Okay. It looks like we've got the majority of participants responding, so let's go ahead and share. So we've got 9% saying it's unconditional because likelihood of not submitting a report is not remote. And I realize you can't see these great. So 56% saying that it's unconditional because the report is administrative. So we've got about 65% of respondents, 66% of respondents saying it's unconditional, and the remainder indicating that it's conditional. So let's go into the analysis on this one. And the answer is going to be that it is not a conditional contribution. I think, Marie, we need to go ahead a slide. Oh, no, sorry, we're there already. So the reason why is that the reporting requirement is administrative in nature. It's not a stipulation related to the purpose of the agreement. It is, as it says here, the purpose of the grant is to perform research. It's not to produce a report on how the funds were used. If it were a research report, then that might be a different story. So the remote thing was a red herring. As we've said earlier, probability assessments are no longer part of this analysis. So you don't really need to consider whether or not it's remote. And again, as I said a few minutes ago, you don't even need to deal with the fact that you might not get the last payment or that payment until the report on how the funds were used. They may not pay you, but you're still entitled to the funds. You have completed the terms of the agreement, and it's more like, well, I'm not going to pay you until you send me an invoice kind of situation. But the work has been done. So the other things that need to be considered are whether or not the grant is restricted. And I think Grant's going to walk us through looking at conditions versus restrictions.
All right, thanks, Renee. So yes, well, next we'll take a look at the difference between a condition and a restriction. And this is an area where diversity and challenges continue to exist, and judgment is going to be required. We've looked at a ton of contribution agreements with our clients, and when you try to apply the provisions of ASU 2018-08, it can be quite tricky because of the way the grants are written. So based on the guidance, a condition requires the nonprofit to meet specific barriers before they're entitled to the assets. And that's a key word, as Renee mentioned, is entitled, and not meeting those barriers would result in return of the funds. Whereas a restriction, it limits the use of the contribution, but doesn't necessarily impact whether the nonprofit organization is entitled to that contribution. And I know it gets tricky, because that distinction between being entitled to the funds versus merely limiting your use of the funds will require judgment. If you take the same agreement and you have it reviewed by a room of highly skilled and trained nonprofit accountants, you're likely going to get varying interpretations. And Renee and I have this ourselves. When we have client situations, we bounce questions off each other, and sometimes she sees it one way and I see it another way. We kind of have to get all the facts and circumstances together. And FASB acknowledges this as well. The GAP guidance states that certain stipulations may create some ambiguity as to whether that contribution is conditional. And GAP recommends that in these instances, it recommends the nonprofit organization to review all the facts and circumstances, reach out and communicate with the donor for more clarity. And if that ambiguity still cannot be resolved, then a reasonable position and a conservative position would be to presume that contributions that are not clearly unconditional are conditional. So if you've exhausted all resources and you still can't definitively say this is not unconditional, then you treat it as conditional. We think we're gonna see grant agreements that contain language like this, where it's gonna be a bit gray. Is it a condition, is it a barrier, or is it merely a restriction? And we think this gray area language may continue to exist, at least during the early stages and phases of adopting and implementing 2018-08, at least until donors and foundations and nonprofits and CPAs and the greater nonprofit community all have a better sense of what truly constitutes a conditional contribution. And then we're likely going to see just a wording and grant agreement more clearly aligned to the intent and guidance, if you will, of 2018-08. Hopefully this leads to better engagement with the and partnerships with the nonprofits and your donors. Next slide, please. Oh, now it's polling question number 3. Okay, so in this example, the agency receives a $2 million contribution from a donor to promote awareness about social distancing. The grant agreement includes a line item budget and requests that the nonprofit use the grant funds for certain specified expenditures, and it seems to indicate that the agency may be liable to return the funds not used in this context. It's not directly clear, though, from the grant agreement as to whether the agency is required to meet the stipulations in order to be entitled to the funds. The agency has reviewed all the facts and circumstances. They've contacted their donor for clarification, and some ambiguity still exists. So this is an example where it's a bit hard to tell if it's a condition or a restriction, and there's a line item budget in there that's causing some of this confusion as to whether or not they need to follow that budget in order to be entitled to the funds. So the question is, how should the agency account for this contribution? I think we're ready to launch the polling question. There you go. So do you think it's unconditional and restricted, conditional and restricted, or is it open to interpretation? And again, this is an example where you have a line item budget and there's some ambiguity as to whether or not meeting that budget is a stipulation in order to be entitled to the funds. Like we have 80%, 82% of folks have voted. Leave it on for another 10 seconds or so. All right, looks like the answers are in. And we see the answers are sort of distributed all around, and that was sort of the intent of this question, is that we're going to see in real life a lot of these situations where it's hard to determine, and there really isn't a wrong answer or a right answer in this situation. I think what I was going for is it's open to interpretation. As I mentioned earlier, you have the same agreement, or you have it reviewed by a room of CPAs and accountants, and some say it's unconditional because of the line item budget is generally not an indicator of a condition. Some may say it's conditional because we've exhausted all our resources and we've looked at all the facts and circumstances, and there's still some ambiguity, and some may fall in the middle and say we just need more information. So let's go to the analysis, Marie. I think, yeah, there you go. So this is an example, as I mentioned, where it's really hard to tell if you have a condition or a restriction. And that's because the line item budget, as Renee mentioned, has led to a lot of different views as to whether a budget would constitute a limited discretion indicator. The FASB actually issued some specific guidance on budgets and more or less stated that budgets alone generally would not be a barrier. And that's because budgets are more of a guidepost to help navigate how the funds should be spent, but they're not necessarily a barrier for you to be entitled to the funds. But in certain situations, that budget might be a barrier. So the recommendation is to examine all the facts and circumstances, contact the donor for clarity. Also look at how your similar grants have been treated with the foundation. You know, have you had situations where they've had a very stringent budget, and if you spent outside those budgets, you had to actually return the funds? If so, that might be an indicator that that budget is a barrier for entitlement. Or have you had situations where you've been able to spend more or less within the budget, and you've been able to repurpose and spend those money for other sources where it's really not a barrier to entitlement? So, you know, we really think this 2018-08 is going to really require us to really reevaluate how we think about contributions. All right. So when does 2018-08 go into effect? So for nonprofits that are receiving the resources, it goes into effect for contributions received for fiscal years beginning after December 15th, 2018. So if you're a calendar year end, the standard is in effect for your 12/31/19 year end. If you're a 6/30 year end, it's going to be in effect for 6/30/2020. For resource providers, you're the grant maker. This goes into effect 1 year later. So 12/31/2020 for calendar year end folks, and 6/30/2021 for 6/30 year end folks. All right, next slide. Okay, we're going to switch gears a bit now, and we'll look at the accounting treatment of PPP loans, Payroll Protection Program. Many nonprofits have received PPP funds, and there's been a lot of questions from both nonprofits and for-profits as to how PPP loans should be accounted for. Recently, the Center for Plain English Accounting, they're a division of the AICPA, they issued a white paper titled Accounting in the Fog of War, Treatment of PPP Loans. It's an aptly titled white paper because lately accounting and the world around us really have been cloudy, murky, and uncertain. So based on that white paper, the guidance states that if a nonprofit intends to seek forgiveness of the loan, then the nonprofit should follow ASU 2018-08. And that loan, the portion that's expected to be forgiven, essentially will be treated as a conditional contribution. That's because both those criteria that Renee mentioned earlier are met, right? There's limited discretion on use of the funds. You have to use it within the very narrow guidelines of the PPP program, and it's a bit more stringent than just a line item budget. And if the funds aren't used in accordance with the strict guidelines of the PPP program, then it has to be repaid. Essentially, you're treating your PPP loan similar to how you would treat a federal cost reimbursement grant. So therefore, you would recognize a revenue when a qualifying PPP expense is incurred. Okay. Important to note that the likelihood of incurring a qualifying expense is not a factor, and that's because that probability assessment does not apply under 2018-08. All right. So on your balance sheet, you would treat the portion of the loan that is expected to be forgiven as a refundable advance. So any funds at year end that you haven't spent yet, but you expect to be forgiven, treat it as a refundable advance. The portion that you expect to repay that you don't think you'll incur a qualifying expense on, you treat that as debt, and you would also accrue interest on the portion to be treated as debt. So fairly straightforward balance sheet presentation. Next slide, please. Double dipping. The matter of double dipping has come up a lot in conversations, especially amongst nonprofits that receive government grants and contracts. There has not been a lot of, any definitive guidance or clarity on this matter. We've exchanged correspondence with various federal agencies, including the SBA. So they're aware that more guidance is needed. They're aware that the nonprofit community has questions in this area, and we're hoping to get that guidance soon. But just based on our understanding of how the government operates, when we look at the language in the uniform guidance, if we look at the intent and the spirit of the PPP program, just through our initial conversations and dialogue with the federal agencies, we're of the position that you likely can't have the same payroll costs be paid for with PPP funds that will be forgiven and also charged through to the federal award. That's basically because the government doesn't want to pay for the same cost twice, right? But there's still a lot of questions that remain. Back one more slide, the previous slide, please. Yeah, so just to wrap this slide up, we think you can't charge the same cost twice, but a lot of questions still remain. Does this apply to non-federal government grants like state money, county money, local money? We're not sure if you already have a government contract in place to fund certain salaries. Do you have to use that source first, and what's the order of the money that you use in? We've seen some conflicting information out there. How does it impact restricted funding? Still a lot of questions. We're doing our best to try to gather that information, and we'll let you all know when we have more information.
Yeah, the restricted funding, I'm just going to interject real quick.
Mhm.
Foundation funding, I think, is an interesting question because GAP says you're supposed to spend restricted funds first unless there is a unrestricted source that contractually would require spending the unrestricted source first. So I think that would probably apply in this situation. And my guess is that many foundations would view the PPP forgiveness really as an infusion of unrestricted funds. You might want to just have a conversation if you've got large funders to make sure they're okay with you saying, hey, we have this position that you were funding, but we've used it for PPP forgiveness, but we still did the thing, so we'd like to release the restriction even though we used it to obtain forgiveness.
Yep, good point, Renee. Next slide, please. So just for financial statement disclosure purposes, you want to include the amount of the loan if you did in fact receive a loan, the dollar amount that was spent on qualifying expenses, the remaining balance of the loan at year end, and there is a portion that you expect to repay. You can treat that as debt, so all the standard debt disclosures would apply. In terms of presenting the revenue, you may want to consider breaking out that revenue separately on your income statement because it is such a one-time unusual source of income. You may not want to distort your contribution revenue. And I think we have our fourth and final polling question.
We do. So in this one, an institute receives a $3 million Paycheck Protection Loan on May 5th. The institute has a June 30th year end. As of June 30, the institute utilized $2.7 million of the PPP loan on qualifying expenses, and they expect that full amount to be forgiven. They expect the remaining $300,000 to be repaid. So how should the institute recognize the $3 million loan as of June 30th, 2020? So why don't we go ahead and launch that polling question and give you a minute to respond. So we've got 3 choices. Well, a lot of people are voting on this one. Okay, we've got about 86% of participants voting. Let's give it another couple of seconds. And then we can move into looking at our analysis of this. Okay, why don't we go ahead and see how folks responded. So the largest group of people, 85%, said recognize 2.7 million as revenue. Small group said the entire 3 million should be recognized, and 12% said don't recognize any. So let's move forward and look at the analysis. We do think that this is a conditional contribution, and it sounds like everyone has that understanding. We believe that the organization is probably able to recognize 2.7 million of the revenue as of their end of the year. If they have incurred qualifying expenses, again, as Grant was saying earlier, we think that's more like a federal grant, and that if the expenses are qualified, there's no reason why they shouldn't be recognized as they are incurred. Now, a caveat on this, as Grant said, we've been asking for guidance on this. It is still possible that someone might come out and come up with a different interpretation of this, but at this point, we think this is what's most consistent with the standard. The $300,000 that's going to expected to be repaid, that is definitely a loan. If you're not going to be repaying that amount, then it should be done as a loan on the statement of financial position. And as Grant indicated, you'll need to provide the disclosures that would be required for a loan. If the reason why, just to change the fact pattern slightly, if the reason that the funds were not forgivable as of June 30th is simply because there's time has passed and you're still within the, well, now it's the 24-week period, I guess, right? Didn't that happen just yesterday, that the expense period got extended? So if you've got leftovers at June 30th, you're not going to be able to recognize them at June 30th because you haven't incurred the qualifying expenses. But now you do have a little bit more time. And if that's the case, it would still be a liability, but it wouldn't be debt. So you wouldn't need to do those debt disclosures. It would be a refundable advance that you're expecting to get refunded. I think you'd probably want to have a footnote that explains all of this. But yes, so there's a number of different ways that this could be treated depending upon your organization's exact fact pattern. Okay, so what we'd like to do is spend just a few minutes on 606, and we decided to really condense the amount of time that we're spending on this in this presentation because the grant standard is effective now, unless you're a grant maker. The 606 has been delayed. We found out on earlier in May that FASB was considering that. On May 19th, FASB actually voted to do that, and yesterday they actually issued the accounting standards update. So this is official now, and it means that the effective date would be for, if you're a 6/30 year end, it's going to be for your next fiscal year. It would have been for this fiscal year. It has now moved one more year. There's a lot of nonprofits that are 12/31 year ends who have already completed their audit and have adopted the standard, and that's okay. And if you were prepared to, if you're June 30 year end and you were prepared to go ahead and do this adoption, there's nothing prohibited you from doing that. But it seemed there were bigger fish to fry right now. So you do have a little bit more time if you need it. So let's just do a quick recap of this. And there's tons of other Armanino resources on 606 if you'd like to explore those further. So Marie, let's go to the next slide. So just as a reminder, the way that this is going to impact nonprofit organizations is when you have earned revenue or those exchange transactions. And we've got some, common ways that nonprofits would generate earned revenue. Memberships, which depending on what the membership actually consists of, might actually be a contribution. Depends on whether or not they confer benefits of commensurate value. A subscription to a magazine or something like that. Program fees, and by that covers a broad range of activities. Tuition at universities and at private schools, housing at universities, tickets to a performance. So there really are a lot of nonprofit revenue streams that do fall under this standard. I think for many nonprofits, this is relatively straightforward to implement in their earned revenues, but there are situations where it's less straightforward. I think the thing I really do want to just emphasize really quick is that membership issue. Just because something is called a membership, if there's not commensurate value exchanged, or if it's only partially commensurate value exchanged, then you would have either a transaction that is solely a contribution or is maybe partially a contribution and partially an exchange transaction. That's actually the long-standing view of how to treat special events revenue. So we do have something analogous to look at within the nonprofit standards. Just as a reminder, 606, we already know it doesn't apply to contributions, but it doesn't apply to lease contracts. So if you are a nonprofit that is leasing out space to other entities, 606 does not apply. There's a whole nother standard for that. It doesn't apply to insurance contracts, and more importantly, it doesn't apply to investment income, which a lot of nonprofits receive. There is the 5-step model for determining revenue recognition. We're not going to go through that whole thing today. As we said, we've got other resources on that, and we certainly will revisit it again for organizations that do choose to delay implementation. But key thing is when you've got performance obligations. So that is going to be inherent for it to be a contract with a customer. It gets a little bit challenging when there's multiple performance obligations as part of a contract. That is very common in the commercial world, and it can exist in the not-for-profit world. So make sure you're looking at what you've agreed to provide. And there are a few examples that the FASB has put together for the not-for-profit community. You can find that on their website.
And I think we're wrapping up the webinar now. We see a lot of questions coming in, so what we can address today, we'll do our best to respond via email in the next day or so. So just in closing, next steps to prepare for these new standards, I think first is get a really good understanding of the new standards. A lot of good resources out there. There's events like this webinar, there's roundtable discussions, a lot of white papers and blogs and articles out there to help y'all really understand the new standards and assess the impact to your organization. Really think about the impact to your various stakeholders, your board members, your audit committee members, finance committee members, your lenders, your funding agencies. Really help them understand how the standards impact your revenue recognition, how you present your financial statements as well. And really engage all departments of your organization. This has far-reaching impact beyond just the accounting and finance function. It's going to impact your legal department potentially. Development should definitely be involved. So make this an entity or organization-wide project to really understand the new standards and working together to think about how it impacts your organization.
Absolutely.
I think there's one more slide. And for grant makers, for foundations and other folks that do make grants, really revisit the language in your agreement so that your donees are really clear on your intent of the contributions. I've worked with some of my grant making clients and just reviewed some of their contracts, provided our thoughts on if you intend for this to be a conditional contribution, really make sure there's language in there that really clearly spells out what the barriers are and make sure that right of return is linked back to that barrier. As I mentioned earlier, in the first few periods of implementing 2018-08, we may continue to see some of this gray area language, but as we get more really to understanding of the nonprofit communities, what really the intent of 2018-08 is, hopefully we see more clear language in those agreements. Start the implementation process now if you haven't already. Used all the resources available to you. Consult with your CPAs, your legal advisors, your consultants. A lot of folks out there that can help the nonprofit community. Think about any resource needs that you may need to implement to implement 1808 and 606 for that matter. And really think about your internal controls. Do you need to change any process and procedures, especially towards the front end? As you're receiving a grant, make sure you have strong controls at the front end to review that grant agreement to really determine what the proper accounting should be, and engage your development department as well. Make sure they're part of the internal control process. And I think that was it.
Yeah, I think we're out of time, so we probably won't be able to answer questions here. But as Grant said, if you didn't get your question answered in the chat, we'll do our best to respond to you. And if you have further questions, feel free to reach out to us. Our contact information is here, and you'll be getting slides that has all of this for your reference.
Thank you, everyone. Thanks for joining. Have a great rest of your day.